NULL Delivery. Shanghai officially bans public from taking physical silver. The announcement came quietly. No headlines, no panic, just a single directive from one of Asia's largest precious metals trading hubs. Physical silver withdrawal. Prohibited, not delayed. Not restricted, prohibited. While COMEX paper contracts trade at $73, physical metal in Shanghai commands $127, a $54 gap that should not exist. A gap that cannot exist, unless something fundamental has broken. And now, the exchange where East meets West, where paper meets physical, has chosen a side. The question business leaders should be asking is not why Shanghai banned withdrawals. The question is, what do they know that hasn't been announced yet? Welcome to Daily Silver Crisis. If you've built a career making decisions based on reliable information, if you've learned that the most important signals often come before the headlines, then you're in the right place. We don't do hype here. We do pattern recognition. Subscribe to this channel the way you'd bookmark a trusted analyst's research, because what's unfolding in silver markets right now isn't entertainment. It's a case study in what happens when decades of financial engineering meet physical reality, and we'd genuinely like to know, where are you watching this from? Drop your location in the comments. Because this story is playing out differently depending on which market you're watching. Let's begin. On January 27, 2026, something unprecedented happened in global commodity markets. The Shanghai Futures Exchange issued a directive that most people missed entirely. It wasn't broadcast on financial news networks, it didn't trend on social media, but for anyone who understands how precious metals markets actually function, this was the equivalent of a fire alarm in a crowded theater. Physical silver withdrawals from Shanghai vaults were now prohibited, not delayed, not temporarily suspended. Prohibited. To understand why this matters, one must first understand what Shanghai represents in the global silver infrastructure. This isn't some regional trading post. Shanghai is where approximately 40% of the world's physical silver changes hands between Eastern manufacturers and Western financial institutions. It's the bridge between paper contracts traded in New York and actual metal needed by factories across Asia. When that bridge suddenly declares no physical withdrawals allowed, something systemic has fractured. The technical term the exchange used was null delivery status. In plain English, this means that traders who own silver contracts, who paid for silver, who have legal right to that silver, cannot take possession of it. Their contracts still exist. Their ownership claims still exist. But the metal itself, unavailable. Now, exchanges suspend trading all the time. Circuit breakers exist for extreme volatility, but this was different. Trading continued normally. Prices were still being quoted. Contracts were still changing hands. The only thing that stopped was the ability to convert paper ownership into physical metal. Think about what that actually means. Imagine walking into a bank where the statement shows funds in an account. But withdrawals are prohibited. The account exists. The numbers are there. But access to actual currency? Denied. This is precisely what happened in Shanghai. Except the asset in question is a critical industrial commodity that global supply chains depend on. Business executives who manage procurement for electronics manufacturing immediately understood the implications. Silver isn't just an investment metal. It's essential for solar panels, medical devices, semiconductors, electrical contacts, and hundreds of industrial applications. Companies that planned production schedules based on reliable silver delivery timelines suddenly faced a new reality. Contracts mean nothing if physical delivery is impossible. For corporate treasury managers, the Shanghai announcement created a different kind of crisis. Many companies hedge commodity price risk using futures contracts. The assumption has always been that if prices move unfavorably, the contract provides protection either through cash settlement or physical delivery. But what happens when the exchange that's supposed to guarantee that protection simply says, delivery unavailable? The hedge that was supposed to reduce risk just became a source of risk itself. Financial analysts began asking uncomfortable questions immediately. If Shanghai, one of the world's largest and most established precious metals exchanges, cannot fulfill physical delivery obligations, what does that say about inventory levels? What does that say about the relationship between paper contracts outstanding and actual metal available? What does that say about similar exchanges in London, New York, and Zurich? The official explanation from the Shanghai Futures Exchange cited extraordinary market conditions and temporary logistics constraints, but people who've watched commodity markets through multiple cycles recognize this language. Temporary is what institutions say when they don't want to admit a structural problem. Logistics constraints is what exchanges claim when the real issue is insufficient physical inventory to meet contractual obligations. The pattern was familiar to anyone who remembered 2008, when gold markets experienced similar delivery tensions, or 1980, when silver markets broke under the weight of leverage and physical demand converging simultaneously, history doesn't repeat, but it rhymes. And the rhyme scheme here was unmistakable. Within 48 hours of Shanghai's announcement, premiums for physical silver in Asian spot markets began widening dramatically. Metal that could actually be delivered, that could actually be held, that could actually be used in manufacturing, started commanding prices 15% and then 25%, then 40% higher than paper contract prices on COMEX. This price gap shouldn't exist in functioning markets. Arbitrage traders exist specifically to eliminate such discrepancies. When silver is cheaper in New York than Shanghai, traders buy in New York, ship to Shanghai, and profit from the difference. This mechanism keeps global prices aligned. Except it wasn't working anymore. The gap kept widening, and Shanghai's ban on physical withdrawals was both a symptom and an accelerant of whatever was breaking beneath the surface. The business community began to realize this wasn't a temporary disruption. This was evidence of something systemic, something that had been building for months, perhaps years. And Shanghai's prohibition on physical delivery was simply the first official acknowledgement that the gap between paper claims and physical reality had become unbridgeable. The Shanghai withdrawal ban didn't emerge from nowhere. For months before that January 27th directive, 3 separate crises had been converging in the global silver market, each one serious enough to cause disruption on its own. But together, they created conditions that made Shanghai's decision inevitable. The first pressure point came from Beijing. In January 2025, exactly 1 year before Shanghai's ban, Chinese authorities announced new export controls on refined silver. Not a temporary quota, not a tariff adjustment, a strategic restriction on a metal that China refines approximately 70% of global supply. At first, Western analysts dismissed this as routine industrial policy. China controls rare earth exports, lithium processing, now silver refining, just another move in the ongoing resource competition. But people who understood Chinese strategic planning recognized something different. This wasn't about revenue. This was about manufacturing retention. China wasn't restricting silver exports to drive prices higher and profit from scarcity. They were restricting exports because domestic industries needed guaranteed supply for solar panel production, electronics manufacturing, and military applications. When a nation that produces 70% of a refined commodity suddenly prioritizes domestic consumption over export revenue, that's not trade policy. That's preparation. By mid-2025, the effects became measurable. Silver refineries in Switzerland, the United States, and Canada reported order backlogs extending 12 to 16 weeks. Previously, fabrication-grade silver could be sourced in 4 to 6 weeks. Lead times had tripled. And building new refining capacity? Not a solution that could be implemented quickly. Constructing a silver refinery capable of producing London good delivery bars or fabrication-grade material requires 18 to 36 months minimum. Environmental permits, specialized equipment, technical expertise. There was no quick fix to replace Chinese refining capacity. The global silver supply chain had been built on an assumption of open trade and fungible supply. That assumption was now obsolete. While China's export restrictions created a supply bottleneck, the second crisis was unfolding inside COMEX warehouses in New York. COMEX, the commodity exchange, where the majority of Western silver futures contracts are traded, operates on a 2-tier inventory system that most people don't understand. Eligible inventory means silver is stored in COMEX-approved warehouses, but not available for delivery against futures contracts. Registered inventory means silver is actively warranted and can be delivered to contract holders demanding physical settlement. For years, this distinction didn't matter much. There was always enough registered inventory to meet delivery demands, and eligible stocks could be converted to registered if needed. But throughout 2025, something unusual was happening. Registered inventory was declining steadily, not because total silver in COMEX warehouses was disappearing, but because owners were shifting their metal from registered to eligible status, effectively removing it from the pool available for contract delivery. By December 2025, registered COMEX silver inventory had fallen to approximately 40 million ounces, while open interest in futures contracts represented claims on nearly 900 million ounces. The mathematical problem was obvious. If even 5% of contract holders demanded physical delivery simultaneously, COMEX couldn't fulfill those obligations with available registered stocks. The exchange's response was predictable. Margin requirements were increased. Position limits were discussed, and cash settlement alternatives were encouraged. These weren't risk management measures. These were institutional control mechanisms designed to prevent a delivery crisis, but sophisticated market participants understood what rising margin requirements actually signal. The exchange is trying to reduce physical delivery pressure because it cannot meet that pressure with available inventory. It's the financial equivalent of a bank limiting daily ATM withdrawals when liquidity becomes uncertain. The third convergence point was less visible but equally critical. Refining capacity constraints weren't just about China's export restrictions. They were about global bottlenecks in transforming mined silver into usable forms. Silver comes out of mines as doré bars, impure alloy containing silver, gold, and base metals. These must be refined to 9999 or 9999 purity for industrial use or investment-grade bars. Refining capacity is concentrated in a handful of facilities. China dominates. Switzerland handles significant Western volume. A few operations exist in North America. But total global refining throughput had not expanded meaningfully in over a decade. Why would it? For years, supply exceeded demand. Prices were suppressed. There was no economic incentive to build expensive new refining infrastructure. But now, with Chinese exports restricted and industrial demand accelerating from solar panel manufacturing, the refining bottleneck became acute. Miners were producing silver, but getting it refined and delivered to end users was taking longer and costing more. This created a peculiar situation. Silver existed, but not in the form or location where it was needed, and the infrastructure to transform and transport it was overwhelmed. These three factors, Chinese export controls, COMEX inventory depletion, and refining capacity constraints, weren't isolated problems. They were Houshang reinforcing. China's restrictions increased pressure on non-Chinese refining capacity. That pressure reduced the flow of metal into COMEX warehouses, which accelerated the decline in registered inventory, which increased delivery anxiety among contract holders, which created more demand for physical settlement, which exposed the inadequacy of available supply, a self-reinforcing cycle, and Shanghai sat at the center of it, the exchange where physical metal flowed between East and West, where paper contracts were supposed to convert seamlessly into actual silver, was watching the gap between contractual claims and physical availability become unbridgeable. By January 2026, Shanghai faced a choice. Continue allowing physical withdrawals and watch remaining inventory drain to zero within weeks. Or prohibit withdrawals and openly acknowledge that paper claims had exceeded physical reality. They chose acknowledgement over pretense. The ban wasn't the cause of the crisis. It was the admission that the crisis had reached a point where pretending otherwise was no longer sustainable. While Shanghai's vaults were running dry and China's export restrictions choked supply, the price of silver was telling two completely different stories. In New York, COMEX futures contracts traded between $73 and $85 per ounce. In Dubai and Shanghai physical markets, actual metal that could be delivered changed hands at $127 per ounce, a $40 to $54 gap for the same commodity at the same moment in time on the same planet. This shouldn't be possible. In functioning markets, price discrepancies get eliminated almost instantly through arbitrage. If silver costs $73 in New York and sells for $127 in Shanghai, traders should buy in New York, ship to Shanghai, pocket the $54 difference. This arbitrage activity naturally forces prices to converge until the gap disappears. It's one of the fundamental mechanisms that keeps global commodity markets aligned. Except, it wasn't happening. The gap kept widening. Day after day, week after week, the divergence between paper prices and physical prices grew larger. Arbitrage traders who normally exploit these opportunities were sitting idle, not because they didn't see the profit, but because they couldn't execute the trade. China's export restrictions meant silver purchased in New York couldn't be legally shipped to Shanghai for resale. Transport logistics that previously took 3 weeks were now uncertain or impossible. Counterparty risk had escalated. Buyers in physical markets were demanding immediate delivery, but securing transport and insurance became prohibitively complex. The very mechanisms that should have closed the price gap were blocked by the same forces creating the supply crisis. What emerged was something financial markets fear most: a complete breakdown in the relationship between derivative contracts and physical underlying assets. COMEX silver futures are supposed to represent claims on actual metal. The price of those contracts is supposed to reflect the value of physical silver. But when paper contracts trade at $73 while physical metal commands $127, that relationship has severed. Traders began calling it the paper versus physical premium, a polite term for what was actually a crisis of confidence in derivative settlement. Here's what was actually happening beneath the surface. Institutional investors holding COMEX futures contracts started demanding physical delivery instead of rolling their positions or accepting cash settlement. Normally, only 1% to 3% of futures contracts result in physical delivery requests. Most traders are speculating on price movements, not acquiring metal. But as the physical premium widened, that calculus changed. Why accept $73 cash settlement when the same silver trades physically at $127? Smart money started standing for delivery, and when delivery requests increased from 2% to 5%, then 8%, then 12%, COMEX faced the mathematical problem that registered inventory couldn't support. The exchange's response revealed everything. Margin requirements were increased repeatedly, first by 15%, then another 22%, then another 18%. Position limits were tightened. Cash settlement was strongly encouraged through structural incentives. These weren't neutral risk management adjustments. These were desperate measures to prevent a delivery default. When an exchange increases margin requirements 3 times in 2 months, they're sending a message. We need fewer people demanding physical delivery because we cannot fulfill those demands. Sophisticated institutional players read this signal clearly. If the exchange is this concerned about delivery obligations, if they're using margin increases as a tool to discourage physical settlement, then the gap between outstanding contracts and available metal must be severe. This realization created a cascade effect. The more COMEX discouraged physical delivery, the more traders questioned whether their contracts could actually be settled in metal. The more they demanded immediate physical delivery while it was still possible, which increased pressure on dwindling registered inventory, which prompted further margin increases, which further eroded confidence in paper settlement, a self-reinforcing spiral of distrust. Meanwhile, in physical markets, a different dynamic was accelerating. Industrial buyers who actually need silver for manufacturing weren't speculating. They were securing supply for production schedules 6 to 12 months forward. Electronics manufacturers in South Korea, solar panel producers in Germany, medical device companies in the United States, all competing for the same shrinking pool of deliverable metal. When supply is uncertain, buyers don't wait for prices to fall. They pay premiums to guarantee delivery. This is why physical silver in Dubai and Shanghai commanded $120 while paper contracts traded at $73. The physical price reflected actual scarcity. The paper price reflected a derivative market increasingly disconnected from physical reality. Analysts who understood commodity market history recognized the pattern. In 1980, during the Hunt brothers' silver crisis, similar divergences appeared before the market collapsed. In 2008, gold markets experienced temporary backwardation, a condition where spot prices exceeded futures prices, indicating physical scarcity. Both episodes resolved with extreme volatility and significant institutional losses. The current silver situation had all the same warning signs, except the divergence was larger, the duration was longer, and the structural factors driving it were more fundamental. This wasn't a temporary squeeze that would resolve in weeks. This was evidence that decades of paper contract multiplication had finally exceeded the physical metal available to support those contracts. The market was experiencing what happens when financial engineering meets resource constraints. And resource constraints were winning. Shanghai's withdrawal ban was both symptom and accelerant. It confirmed that physical metal had become unavailable at paper prices, and it forced every market participant to choose. Trust the paper contracts and accept $73 settlement, or demand physical delivery and pay $127 premiums. The gap between those two prices was the cost of reality, and reality was becoming very expensive. Shanghai's ban wasn't just about silver, it was a template, a preview of what happens when paper markets built on leverage and derivatives meet hard physical limits. And business strategists who understood this weren't just watching silver, they were watching what this breakdown revealed about commodity markets as a whole. For decades, financial institutions maintained control over precious metals pricing through a specific mechanism, paper contract multiplication. The concept is simple. For every ounce of physical silver in existence, create 100, 200, sometimes 500 paper contracts representing claims on that same ounce, as long as only a small percentage of contract holders ever demand physical delivery. The system functions. Price can be managed through derivative trading volume, volatility can be suppressed through coordinated futures selling, and physical scarcity never becomes visible because most participants never ask for actual metal. But this control mechanism has a critical vulnerability. It only works as long as confidence in paper settlement remains intact. The moment significant numbers of contract holders simultaneously demand physical delivery, the mathematical impossibility becomes exposed. You cannot deliver 500 ounces of paper-claimed silver when only 1 ounce of physical metal exists. Shanghai's withdrawal ban was the moment that vulnerability became undeniable. The control system wasn't failing gradually. It was breaking suddenly. And institutions that spent decades managing silver prices through derivative leverage were facing a new reality. Physical demand was overwhelming paper supply. Market analysts like Michael Oliver began publishing price targets that seemed absurd to conventional observers. $300 per ounce silver, $500 per ounce in accelerated scenarios. These weren't hype-driven predictions. They were technical projections of what happens when institutional price control fails and markets reprice based on actual physical scarcity rather than paper contract abundance. Oliver's analysis focused on a specific pattern. When long-term suppression mechanisms break, prices don't return to normal. They overshoot dramatically in the opposite direction. The energy stored in years of artificial price suppression releases rapidly. His $300 to $500 targets weren't based on industrial demand fundamentals. They were based on what happens when decades of leveraged short positions must be covered in a market with insufficient physical supply. For business executives, the question wasn't whether Oliver's numbers were correct. The question was, what planning assumptions make sense when traditional price forecasting models have clearly failed? Companies with direct silver exposure faced immediate strategic decisions. Electronics manufacturers dependent on reliable silver supply for circuit boards and contacts. Solar panel producers requiring silver paste for photovoltaic cells. Medical device companies using silver for antimicrobial applications. All had to reassess procurement strategies built on assumptions of stable supply and predictable pricing. The standard approach, just-in-time inventory and spot market purchasing, suddenly carried unacceptable risk. What happens when spot markets freeze? What happens when prices gap 40% in a week? What happens when delivery timelines extend from 6 weeks to 6 months? Treasury managers faced parallel challenges. Corporate hedging strategies assumed that futures contracts would provide protection against commodity price volatility. But if futures exchanges can't guarantee physical delivery, if paper contracts settle in cash at prices disconnected from physical reality, then the hedge doesn't actually hedge anything. It becomes a speculative position with counterparty risk. The smart money started repositioning, not based on price predictions, based on structural understanding that commodity markets were entering a phase where physical possession mattered more than paper claims. But the implications extended beyond silver. Shanghai's withdrawal ban established a precedent. When physical supply becomes critically scarce, exchanges will prioritize institutional protection over contract integrity. This template could apply to other commodities experiencing similar dynamics. Copper, where refined supply is concentrated and industrial demand is accelerating. Platinum and palladium, where automotive and industrial applications face supply constraints. Even lithium and cobalt, critical for battery production in an electrifying economy. Any commodity where paper contract volume significantly exceeds physical availability could experience similar breakdowns. The geopolitical dimension added another layer of complexity. China's strategic use of export restrictions on refined silver demonstrated that commodity access is now a tool of economic statecraft. Nations controlling refining capacity, processing infrastructure, or mining resources can weaponize that control, not through military force, through administrative decisions that reshape global supply chains. Business leaders operating in this environment needed new frameworks. The old model. Global markets are efficient, arbitrage keeps prices aligned, contracts are reliable, was obsolete. The new model required accepting that. Physical resources are finite and unevenly distributed. Paper claims can exceed physical availability indefinitely until they suddenly can't. Institutional systems will protect themselves even if it means abandoning contract integrity. And supply chain resilience matters more than cost optimization when access becomes uncertain. The timeline for strategic adjustment wasn't measured in years, it was measured in quarters. Companies that recognized the Shanghai silver ban as a signal, rather than an isolated incident, were already repositioning, securing long-term physical supply agreements, diversifying away from exchanges with delivery uncertainty, building inventory buffers despite the capital cost, reassessing which markets could be trusted for critical input procurement. Those who dismissed it as temporary volatility were operating on outdated assumptions about how commodity markets function under stress. Shanghai's ban wasn't an ending, it was a beginning. The moment when paper market assumptions met physical reality, and physical reality won. Business strategists who understood this dynamic were positioning accordingly. Those who didn't would learn the hard way. The market was teaching a lesson that couldn't be ignored. When claims exceed resources, resources always win.